My name is Preston Lovelace. I'm the president of ADS Lovelace and Associates here in New Orleans, Louisiana. I cover Louisiana and Mississippi and parts of southern Arkansas. But I'm a member of ADS Transitions, which is a nationwide organization of 22 independent practice brokers that cover basically the entire United States. We do practice evaluation, sales, consulting. And there's probably somebody in your neighborhood. I'm an attorney here in Louisiana. I got started in this business while I was waiting on my bar results and Hurricane Katrina blew through. And I started working with my mother, who's been an ADS member for about 30 years. And so I've been doing this ever since for about 17 years. And I'm going to talk to everyone about associates. How do you add an associate to your practice? Do you need to add an associate to your practice? What do you pay them? All that other good stuff. But first, yes, I am an attorney. No, I am not your attorney. Just because I'm giving you legal information doesn't really mean that I'm giving you legal advice, particularly if you don't live in a state called Louisiana. You might want to talk to an attorney where you live because state laws vary pretty widely on this sort of stuff. I mean, there are some federal employment laws that everyone has to follow, but states can do stuff on top of it. So I'm going to give you some information about the law, but I'm not your attorney and don't rely solely on this webinar to make any sort of legal decisions about associates or their contracts. So today, what am I going to talk about? The first thing is do you need an associate? Not every practice needs to have an associate. Not every practice is big enough to have an associate. Not every practice has the room to add an associate. Then I'll talk about pay and benefits, go over some common pay schemes, the pros and cons of each, and maybe some hybrid schemes that people can look at. Then I'll talk about the contract. What sort of stuff needs to go into the contract, because yes, oral contracts are valid, but they're very difficult to enforce. So it'd be nice if we could get everything in writing on the front end so that there's less room for misunderstanding in the future. Then I'll talk about associates and how that works with transition planning. And then I'll open up the floor for some questions and answers. All right. So do you need an associate? There's really two things you have to have in order to need an associate. One is work for the associate to perform. If you're a single doctor in a single doctor practice and you work 4 days a week, that's great. But if you bring in an associate, that doesn't necessarily mean that there's work for them to do. And so you might either be willing to work less and give up a couple of days of your production or a day or two. Or the alternative is if you have unmet demand for services. You know, if you can't book a new patient or see a new patient for 2 to 3 weeks, if you can't see a current patient for a month or two, then yeah, there might be room to add in another person. But just because you add another body doesn't make your practice, doesn't mean that there's enough work for an additional dentist to do. So you need to account for how they're going to get their patients and get their book of business. The second thing you need is operatory space. 2 operatories per dentist is ideal, and then you might need a couple operatories for a hygienist, which means if you have a 4 operatory practice, 2 dentists and a hygienist is pretty tight in a 4 operatory practice. You can squeak by with giving your associate a single operatory, but it's inefficient. It's nice to have at least one overflow room for everyone to put either extra hygiene or extra patients for the practice in. One thing you can do if space is short in your office, if you don't have enough operatories to really add a new associate, but you only work 4 days a week, well, maybe you open up the office on Friday and Saturday, or or have fewer, more days or maybe longer hours, work later into the evenings some nights, and that gives enough office time to where you can factor in sorry, I'm trying to get the video to work, it's still not going. To have enough space, you can add time to add space. However, if you plan on doing that, pay attention to the corresponding increase in your overhead expenses, because if you extend the hours of the practice, you have to extend the hours of many of the employees. You have to, pay people to be there. And if you're open more than 40 hours a week, you might need to add more employees or start paying people overtime, in which case that can start to add up, and it can be more costly to add an associate that way. What about making money on an associate, right? If you want to add an associate to your practice, ideally you'd like to make some money off of them. So what you need to cover is your overhead expenses and the pay for the associate, and hopefully have a little money left over for some owner profit. Generally, overhead expenses are in the low 60%. If you don't count the pay to the owner and pay to the associate. It's, what does it cost to run the practice without the doctors? Well, if you're paying them in the if your overhead's 62, 63%, and you're paying them 30%, that leaves you about 7% of worth of money to make on them. However, if you built the Tooth Mahal and and you're in a really high demand location and have a lot of overhead expenses going, the profitability makes it a little tighter after you pay the associate. But the real upshot of this is the first thing you have to do before you decide you might need an associate, might want to add an associate, is figure out what it costs you to run your dental practice. Pull out your profit and loss statement, look for things that are, technically money kind of leaking through the business into your pocket, like automobile expenses and your personal life insurance and any of the variety of other things that people write off through their business, and know that that's owner compensation, so you can kind of factor that out and see what the bottom line expenses to run your dental practice are. And that tells you how big the slice that you have to offer an associate is. I've run into many a dentist who has lost money on an associate after they've paid the expenses, particularly if you're paying an associate high market values in the 38 to 40% of what they produce. I mean, if your overhead's 65%, you're paying them 40%, then you're losing 5% on your associate. So the first thing to do is to figure out what your overhead is and how much room there is for you to pay that associate. Keep in mind also that if you're going to be giving up time, if you've got 4 days of clinical work and you're giving up 1 or 2, well, not only will you have to pay that associate, but you also won't see that money coming into your pocket. So it can cost more to add an associate if you don't have extra room or demand. Hey, what do you pay an associate? Sorry, got the planes flying over. Pay varies with location. In different parts of the country, different amounts are what's standard. So I'm going to talk general guidelines, what I see in Louisiana and the Gulf South, but generally this is about the same nationwide. In some areas, like large cities where there are an abundance of dentists, sometimes it can go lower than that because there's more dentists looking for work. Conversely, if you're in a rural area and you have to, really dangle some good bait in order to get an associate to move out there and start working for you, you might have to pay them high market rates or higher than market rates in order to incentivize someone to change locations with you. The average new dental graduate owes around $300,000 in student loan debt, which is a pretty big number, and their debt service starts within 6 months of graduation. Which means that most of them are looking for a full-time job and do not want a part-time job. And that runs against the do I add an associate conversation that you have with yourself, because many practices are large enough to have a part-time job. They can't add another dentist full-time. They can only add them part-time, and that leads to some other considerations like non-compete agreements and stuff that I'll talk about later. But the upshot is most dentists are looking for a full-time gig. If you can't give them a full-time gig, sometimes they can combine more than one practice or more than one associate position, provided that the practices are far enough away from one another to keep their bosses happy. Let's talk about common pay schemes. One common way to do it is a per diem flat rate. That's, if they show up, you pay them. If they work a full day, you pay them the amount. If they work a half day, you cut the amount in half. The good part about a per diem flat rate for an owner is it's easy to determine your cost of labor. You're going to be giving them $450 a day, $500 a day, whatever it is. Hopefully you can keep them busy enough that their production will outstrip the per diem rate. If it doesn't, we will probably get to the part of the conversation later where you're terminating them. Because if you can't keep them busy and it's costing you every day, then it starts making it financially feasible to cut them loose. The other thing you can do is a percentage of production. The good thing about a production-based scheme for the associate is there's no lag between their work and their pay. If they work at the end of the pay period, their production gets totaled up and adjustments get taken off, and they get that amount. Their revenue isn't dependent on the deadbeat patients who don't pay. The bad part of this for the associate is they get a lower percentage due to uncollectible accounts. So if you're paying on a production-based scheme, usually you see 25 to 30% of the production, adjusted production, which leads me to collection. Some schemes pay on collection, where I don't pay my associate until I actually receive the money and deposit in the bank. The good part of this for the associate is they usually get a higher percentage. The good part of this for the employer is that uncollectible accounts, they don't have to pay the associate on. So depending on how good your collections department is in your individual practice, you can you can adjust that up or down. The bad part about collection, particularly on the associates end of thing, is that pay lags behind production. So they're going to show up at your office and start working, and they'll work that first pay period, and chances are you won't have collected a whole lot of money in that first pay period, and so their first few checks are going to be small until money starts rolling in on the insurance claims and stuff like that. I do often see a lot of people who are paid on a production scheme. They're paid a percentage of production. And then when you look at the write-offs, one of the adjustments is uncollectible accounts, which if you're adjusting off uncollectible accounts, you're really paying them on collection. They might call it adjusted production, but it's usually collection. Which some contracts will combine these kind of pay schemes. They'll say 30% of collection or $450 a day, whichever is more. This is an average over the pay period. It's not a daily rate. So, and it's not, over the 2-week pay period times $450 is $4,500. If 30% of the income is $450 or greater than $4,500, then you pay them the percentage. I also see sometimes, particularly in DSOs, production goal-oriented schemes. This sets a base pay rate, 26.5% on the first $40,000 each month, something like that. And then they have a sliding scale bonus based on production. So, between 40 and 50,000, you get 28%, but anything over 50,000, you get 30% of, and that kind of incentivizes the associate to get in there and work hard every single day. Issues about pay schemes, this is what I talked about with adjusted production. It really depends on the employer's definition of the term. Like I said, sometimes they call it adjusted production, but then they adjust off non-collectible accounts, which makes it collection. But common things that get adjusted off almost always without complaint is discounted fee schedules. So if you're on a PPO plan and they're in-network and they're paying you the in-network fees, obviously you're not going to pay the associate a percentage of the top line fees. You're going to do the percentage of the fee that you actually receive. Other discounted pay plans, sometimes I've seen contracts where if it's care credit or some other financing, the owner or employer will charge that back on the associate. I see that less rarely. Credit card fees, I did actually see one time. I don't usually, but I helped a young dentist accept an employment agreement somewhere, and she called me about 2 years later. And she said, "He's charging me the credit card fees." And I said, "Let me look at the contract." And I looked at the contract, and I said, "It says adjusted production. It does not say credit card fees. Y'all need to have a conversation because credit card fees usually 2-3%, and 2 or 3% off of your pay is that's real money." Lab fees, usually always see lab fees taken, but lab fees, keep in mind that it's they pay a proportionate percentage of the lab fees. You don't charge them 100% of the lab fee. You know, if 30% of the adjusted production minus lab, that's 30% of production minus 30% of lab. I have seen some employers who actually said, I'm only gonna charge you half the lab, and then they deduct half the lab from the production. Well, 30% of 50% is 15%. So they're really kind of giving the associate a raise by only charging them 15% of the lab. Other lab fee adjustment things to pay attention to: if you have a CEREC or some other sort of CAD CAM or a lab that's internal to the office, you need to figure out a way to address how those costs are factored in. You know, the blanks for the mill cost money, wear and tear on the mill and the new burrs for the mill and all that costs money. Either factor that into your total overhead when you're figuring out how much room you have to pay your associate, or charge your associate a per blank fee or something like that, per unit fee, to account for the fact that you're not using an outside lab. Benefits. You know, benefits are great. All of them love benefits, but associates usually get high pay or extensive benefits, not both. You know, if they're going to be paying someone 32, 33%, or maybe even 35%, I doubt you're going to be giving them, you know, professional liability insurance and continuing education or something like that. Just because you can't, you know, you've got to pay attention to what it actually costs you to have that associate in your practice. Health insurance, I occasionally see that. Often it is deducted from pay. They'll allow the person to pay it with pre-tax money and deduct it from their pay so that they're not paying taxes on that. Life insurance, I rarely see that. Sometimes you'll see life insurance if there's been a buyout in place. If we've, you know, sat down at the beginning and said, you're going to buy in and you're going to buy out, here's this and here's that, and now we're going to get life insurance, or you get life insurance on the seller. If he dies, then your life insurance will buy the practice. I rarely see life insurance on the associate, though, unless they've already bought in. So if it's a 50-50 buy-in, they'll often have life insurance on each other to handle the buyout if the other person dies. Disability, rarely see that. Usually the associate has to get it themselves. Professional liability, I often see that together because the owner wants to determine what insurance company provides the policy for the office. And you particularly don't want multiple insurers in the same office covering different dentists, just because then the insurance companies have room to start nitpicking over who did what. You'd like to have one insurance plan that covers everybody, and then maybe you can either provide it as a benefit or charge them for it. Continuing education, you know, I see it all ways. I see no continuing education covered. Sometimes I see an annual allowance, like, oh, you know, here's $2,000 a year. Many times I see the contract state, you have to take this implant course or you have to take this other course and I will pay for it. And then if you know, if the employer is mandating that they go, the employer usually puts the bill. Uniforms, its office has uniforms, usually always by the associates or scrubs or something. Retirement plan, sometimes yes, sometimes no. It often very much depends on the classification of the employee, whether they're a W-2 employee or a 1099, you know, independent contractor. What else? With the signing bonus. Signing bonuses are popular with corporate practices. The DSOs like to give them, and rural practices, the practices out in the country like to give them because it's good. You know, hey, 10 grand the day you show up is a good way to get somebody on board with moving to wherever you need them to be. Signing bonuses, be sure if you give one of these that you have some sort of clawback provision in the employment contract that's based on the length of employment. So if you've hired, you know, you give them 10 grand to come work for you and the contract's for a year or 2 years, it should say you get a pro rata portion back. If they quit after 6 months, they owe you 3/4 of the bonus back, right? Other contractual considerations. This is the employee or independent contractor thing that I spoke about earlier. The IRS likes to look at the degree of control exerted by an employer on the employee as to tell whether or not they're an employee or an independent contractor. Traditionally, an independent contractor is, think of like, if I've hired a general contractor to build me a house, and he subs out the plumbing, the plumber is an independent contractor to the contractor, because the plumber has all his stuff in his van. He's told where to go and what to do, but he shows up and usually makes his own hours and instructs his own people, brings his own supplies, does everything, and they are independent of one another. The other thing the IRS focuses on is it a key business activity? This is the big one, that sticks in my mind when I think of this issue. If you're hiring a general dentist to come do general dentistry services in your general dentistry office, that's a key business activity. They are probably an employee and not an independent contractor. They additionally look at the independence exerted by the employee. Is there a significant investment by the contractor in their tools, stuff like that, like the plumber's van full of stuff? Well, if the associate's showing up and you're giving them a handpiece and you're giving them an assistant, you're giving them a chair and you're giving them a patient, that very much the IRS would like to think that person's a W-2 employee. So if the IRS ever gets involved, they're probably going to say it's a W-2 employee, unless sometimes specialists. So if you're employing like a periodontist or an orthodontist to come into your office one day a week or one day a month and do stuff on your patients, those guys are independent enough to have an argument that might pass muster. However, after all that I just said, the vast majority of contracts I see try and hire their associates as independent contractors. I talk to your CPA. Your CPA will go through the IRS rules that I just talked about, and some CPAs are comfortable with it, some CPAs are not. The reason most general dentists want their people to be independent contractors is because they get to avoid the matching the Social Security and Medicare withholding, right? If they're a W-2 employee, you got to withhold from them, and then you got to match it, and that's 7.65% of their income. And 7.5% is nothing to shake a stick at. And so if you can offload that onto them as an independent contractor, you want to try and do that. Now, conversely, the savvy associates know that they're getting that extra 7.5% knocked onto their side of the ledger. And so they will, if you're paying me an independent contractor, you're going to pay me more, et cetera, et cetera. So the employee generally would rather be a W-2 employee. The one good thing about if they're a 1099, then they can write off their own expenses through their corporate entity, and some associates like that as well. But talk to your CPA, see what they think. Other contractual considerations. What has to be in the contract? The names of the parties, right? This seems obvious, but if they're an independent contractor, are you employing them Bob Smith, or are you employing Bob Smith's Professional Dental Corporation in order to provide the services of Bob Smith? Well, usually it's that second one if you want to pay them as an independent contractor. At the end of usually the employer is not the owner doctor, it's the owner doctor's corporate entity. But if you're if you're not incorporated, if you're a sole practitioner, then it can just be Dr. Jones employing Dr. Smith. Second thing that has to be determined: are you an employee or are you an independent contractor? It must be specified in the contract. Then the term of the contract. This one seems obvious, but we need to have a start date. We need to have a date that it ends. Or it could be perpetual until somebody quits, but usually it's, this contract is for a year. Sometimes they'll have renewal provisions and say this automatically renews unless the associate gives me 30, 60, 90 days notice. Sometimes it'll say this automatically expires unless the associate affirmatively opts in each year. It just, there's no right way. It's just how the employer wants to work it. Other thing that the contract needs to go over is the pay schemes that I talked about earlier. If it's per diem, it's kind of easy. This much per day, or a pro rata amount for working less than a full day. If it's doing the percentage of production or percentage of collection, you definitely need an exhaustive list of all of the adjustments you're going to make, because that's usually the way that works. Let's see what else. Work hours. How many days a week are they expected to work? How many hours each day? Who takes emergency call? If the office is open on Saturdays, who does Saturdays? Many contracts will say full-time, 4 days a week or 40 hours a week, as determined by the needs of the practice or something like that, and kind of leave a nebulous term so that you can say, well, I need you today, I don't need you tomorrow. But keep in mind, if you keep not needing an associate, they might quit and go somewhere else. Termination provisions. This one's particularly important. The default rule is what's known as at-will employment. So you can be quit or be fired for any reason or no reason at all. But since dentists are professional services, you don't want to leave the patients and the practice in a lurch. So most contracts have a notice period of at least 30 days. Sometimes it's 60 or 90 to quit as an associate or to terminate an associate. Actually, most will say that the employer can terminate at will anytime for whatever, just because if you fire them, you don't want to have to let them work another 30 days. And then it'll say the associate can quit, on notice. There is a thing known as employment for a term, and now keep them in mind. State law may vary, but in general, if the contract says Bob Smith is going to come work at Dr. Jones's office from January to December of this year, and elsewhere in the contract it doesn't say that he gets to quit or anything like that, that's known as employment for a term, and he's agreed to work that entire year. And if he quits, theoretically, the owner could go after him for lost revenue from quitting. It's kind of hard to collect on that, but I've seen some associates try and quit and have the owners come at them and say, no, you agreed to work for me for a year, and you got to stay for the rest of the year. Usually, though, it's a notice period, 60 days notice, because if you don't want to be here, generally, I don't want you here, right? Benefits. At least outline any of the benefits I went over. How many vacation days? Are they paid or not paid? What are the office holidays? If we take Mardi Gras or Christmas or something like that off, you need to list that. Any insurance benefits, if you're going to pay their malpractice insurance or something like that, that needs to be listed in the contract. And finally, if not most importantly, the non-competition agreements need to be in the contract. Now, this is the part where I tell you, yes, I'm an attorney, but I'm not your attorney, and I'm in Louisiana, so I can tell you what Louisiana is like, and I can tell you that a lot of states are different, and many states are very hostile to non-compete agreements. In principle, they don't think that a professional should restrict themselves, that a state should restrict a professional from practicing their profession in that state. Why? Because it's counterintuitive and self-defeating. But generally, your business, dentistry, is a relationship-based business. Patients will stick with their dentist. They will like their dentist. And if you bring a new young dentist in and he treats those patients for 2 or 3 years, they might start to think of him as their dentist. And if he quits and moves across the street, that's a big problem for you. Some patients will follow an associate if it's convenient. Some associates will go out of their way to recruit patients. I had an incident here in New Orleans maybe 10 years ago, where it was a high-rise office building, and there was a big pediatric dental office on one of the floors, and they offered their associate a buy-in, and the associate said, "That's too much money. I don't want to play that game." And they didn't have a non-compete, so they just went to the landlord for the building and said, "Do you have any office space?" And they said, "Yeah, we got some on that floor." And so they printed up a sign that said Dr. X's patients this way with a big arrow, and stuck it right in front of the elevator well, and started poaching as many patients as they could. Another one I had was a doctor hired a new associate, and the new associate started working in the practice, and everything was great. And he got along with the hygienist so well that he married her, and the employer threw him an engagement party and did the whole thing. And then a few years later, he came to them and said, "Hey, I'd like for y'all to buy my dental practice. I'm about to retire." And they said, "Your practice is full of old equipment, and we've already got all the patients anyway. And I don't want to buy your used equipment in your old building. I'm building my new practice up the street." And so they built a practice, both quit, started a new practice a few blocks away. And the hygienist and the young dentist were right there, and they took about 50% of that guy's practice with them. So protect yourself. The road to hell is paved with good intentions. And when it comes time to talk about money and talk about business, there's no such thing as biz friends. Generally, with a non-compete agreement, it must be reasonable in scope and duration, right? If you're a single location dental practice, you can't tell your associate that they have to leave the state. You can usually say, 2 miles, 5 miles. In Louisiana, for example, you can have the parish, which is like a county, or surrounding parishes, provided you're attracting clients from those areas. So as long as you've got patients coming in from the outside counties or whatever, you can try and have a non-compete that covers it. But generally in big cities, in New Orleans, 5 miles. In the country, you want parish and surrounding parish or county and surrounding counties, just because people will drive further to see a dentist because they have to. In New Orleans, for example, nobody's going to cross the bridge and go to the other side of the river to see a dentist, whether they live on the West Bank or in New Orleans. So most of the non-competes I draw up are a 5 mile radius, not accepting the river. You can do that, but check your state laws, right? The second way that the agreement must be reasonable is in duration. In Louisiana, it's 2 years from the termination of employment. Some states will let it go 3 to 5 years. Most banks are looking for around 3 years unless the state law limits it to 2 or forbids it. Associates do not want to sign non-compete agreements because if they're moving to your town, they don't want to draw a big 5 mile circle of places they can't be. However, if they are a full-time associate, you can make no exceptions. If your practice is big enough to keep you full-time and keep an associate full-time, you have to protect your interests. You can always make a concession to the employee after their employment is terminated. Once they quit and you've drawn your 5 mile circle or whatever, and they come to you, and they can always mother may I, I found an office here, I'd like to start an office there, I'd like to buy an office there. And you can say, yes, you have my blessing. But what you can't do is after they quit coming and impose a non-compete that they had not already agreed to. So hit them on the front end and be nice on the back end if you feel like it. For part-time, you got to use your best judgment. It's really hard to demand a non-compete agreement from somebody if you can only keep them busy 2 days a week. It's still a good idea to have one. If they'll sign it, please get it. But if they won't sign it, understand that a 2-day-a-week job is not enough to really make someone sign a non-compete. Now, if the practice grows and it becomes a 3-day, 4-day-a-week job, well, at some point you got to walk up to them and say, look, if you want another day, I need a non-compete. What about transitioning to an associate? Some people want an associate and never want to sell it to the associate. I know a lot of young dentists who are, 38, 40, and have brought in a 26-year-old associate, and they don't want to sell anything because they want to actually make the money from owning a practice. And so they've had to tell that associate, like, you're not getting a buy-in for 10 or 15 years because we're just too close in age. Now, if you're 55 and you're bringing in a 26-year-old, obviously dangling the potential to buy is an easy way to get them to come on board. But you definitely need to manage their expectations with the timing of it. If the waiting period's too long, they'll start looking for other opportunities. The phone rang for me 2 weeks ago, and I was helping a dentist evaluate their practice to sell a part of it to somebody, and it was the associate. He was saying, I'm looking for other jobs because I don't know if this buy-in's going to be right for me. And I said, I can't really help you, but I'll pretend I didn't hear that. About 5 years has a way of never coming to pass. One of my friend's dads was a dentist, and when he got out of dental school in 1978, he moved to Baton Rouge and started working for an older dentist who told him he'd sell it to him in 5 years. And that was 1978. And when we were juniors in high school in 1993, his dad finally got to buy that practice after 15 or 16 years. And that's kind of lost revenue, and to his credit, they got along great and it all worked out fine in the end. But 5 years from now is wonderful until the economy tanks and your investments start hitting up. I had somebody call me who agreed to a partial buy-in with a buyout in a few years, and they said, is there any way we can undo this? And I said, not really. You can go and ask nicely to the person who has the option to buy the rest of your practice. But you can't, once you've agreed to it, you kind of agreed to it. An agreement to make an agreement in the future is not an agreement on anything. So if you tell somebody, hey, come work for me and you can buy out my practice in 2 years. Well, 2 years is a close enough time period for us to actually talk in turkey. If you tell somebody, hey, come work for me and I'll sell to you in 10 years, well, 10 years, we can start talking in 5 or 6 years. But if it's 2 or 3 years, we need to figure out a price or when is it going to sell, a date certain, what is it going to sell for, a price, right? Because if you agree, hey, I will sell to you in the future, well, there's no, first off, when is that? And secondly, how much is that? You might have this associate who's the greatest associate ever who works for you for 20 or 30 or 2 or 3 or 5 years. And then you come in and offer him the buy-in and you tell him the price and he says, oh, that's too much, and goes, quits and goes and gets another job. And then you get to start over by hiring somebody else. It'd be much easier to sit him down and say, I want you to come work for me for 2 years, then I'm going to sell to you. Here's what it's worth now. That's this percentage of the income, and you come work for me and I'll sell it to you for that same percentage of 3 years average income. And that way, if the practice grows, then you get a little bit more money. If the practice shrinks for some reason, they pay a little lower price. But you've agreed to something that you can both rely on in the future. And if you can't go this far, I wouldn't dangle a buy-in as a bait for a new associate, because it'll only get them in the door and allow you to generate hard feelings if and when it doesn't work out. Now you can definitely say, hey, come work for me for a year, and in a year we can talk about a buy-in. And that way it's kind of, they've worked for you for a year, and then a year later you can agree on a price for the buy-in in another 2, 3, or 5 years, so that you can kind of test drive them and make sure they're the kind of person you'd like to work with. Additionally, if you're going to be doing a deal like this, if you're going to be continually employed after the sale, we need to talk about that. Usually, if it's good for the goose, it's good for the gander. Whatever you're paying the associate, you just flip-flop, and that's what you get paid after the sale. But we need to know that too if we're doing this sort of stuff. If the practice grows exponentially, that's wonderful. And if the associate comes in and just contributes greatly, and you double the size of your practice, you don't want to really charge them double what the practice was worth when they came in. You'd like to give them a little credit for their effort. I'm not saying cut the price in half or anything like that, but if there's a reasonable price that you would sell to a third party and they've helped grow your practice 20, 30, 40%, well, maybe give them a 5% discount or a 10% discount to give them a little, to reflect their sweat equity. There's no requirement for this, but if you make that downward adjustment, it makes it a little easier for them to swallow the buy-in price. And it's pretty hard to track down a random stranger to buy your dental practice. So if you've got somebody who's in there, who knows the patients, who is clinically capable of treating your patients the way you want them treated, well, then, you can be nice about what you charge them for your dental practice if that leaves you confident that your practice will or their practice now, will continue to treat your patients in the manner that you expect. That's all I have for today. This is how you can reach me. If you're looking for your ADS member in your nearby location, you can go to our national website, adstransitions.com, and look up who the guy in your backyard is. If you need anything, though, just give me a call. There's my email and cell phone number. And thank you, everybody, for participating today.